Good morning, Kookie. Now, RBA's meeting on Tuesday. We're at a really important, I think we're getting close to an important inflection point, potentially. But there's a lot to talk about here. Now, we had the headline 6.8 inflation number, which scared the bejesus out of everybody last week. And then that's a big deal, you know, and everyone's running for the hills and thinking, oh, it's going to be a rate increase on Tuesday, no matter what. But since then, we've had the RBA Governor has addressed the Parliament, and I want you listen to it.
Yep.
I think we should talk about that. And I think also we need to just get a little bit ahead of this these monthly numbers that are coming through, and even going past the so-called trim mean, or we're taking our volatile items, which no one's bothered to do at this stage. I mean, at an official level, I know you have. But I also want to talk about something that came up really interesting this week on that Alan Kohler was talking about. And I know you watched that and you've had a look, gone back and had a look at it, which I think gives us a little bit more perspective as to where we're trending, and does the RBA take that into account? So let's just talk quickly let's talk about what Alan talked about now.
Yeah.
In relation to the 6.8% number that came through on Tuesday, I think it was.
You're quite right. That annual inflation rate on the new monthly CPI, Consumer Price Index, was 6.8, way above market expectations.
Right, just explain how they got to get to 6.8, because that wasn't the calculation. That's an extrapolated calculation based on the monthly number.
Correct, based on the monthly number for the month of April on about 2/3 of the items that are in the normal inflation basket.
Yep.
Like they don't get school fees aren't changed every month. So
insurance policies, insurance premiums.
They're once a year usually. So it's things like fruit and veggies, food, petrol, airfares, which do fluctuate all the time. So nonetheless, it was higher than expected in an annual sense. But when you think about the annual numbers, Mark, you've got to remember that to get to that 6.8 to April, you're including data from last year, June, July, August, September, which were the very high month-on-month readings. And in the months to come, they'll drop out of your run rate.
Yep.
And Alan Kohler's point that he made so nicely a couple of nights ago was if you look at the month-on-month increases, not that annual 6.8, you can see a deceleration in the rate of monthly inflation. Now, monthly inflation can be jumping because of petrol goes up one month or down the next month, you know. So, but even if you strip that volatility out of the month-on-month figures, since December last year, so we've had 4 months of data up to April, it's shown that the monthly figures have trended from around about 0.6, 0.7 per month to 0.5. The last one was actually 0.3%. So, okay.
That's April.
For the month of April, 0.3 for April. So if you annualize that, multiply it by 12, you get 3.6%. That was Alan's point, but he had a lovely chart, as he has a want to do. And it just showed the monthly run rate was slowing down. And so if we get through to June, July, August this year, and you get a 0.9 dropping out of last year's run rate, and it's replaced by, just say, a 0.3, just the mathematics shows that you get a 0.6 cutting off that 6.8 becomes 6.2, becomes 5.5, becomes down towards the trajectory that we all want to see, and certainly the RBA want to see.
So, right. So, just to dig in a little bit, what you're saying and what Alan's saying, and I think it's absolutely worth discussing and worth considering, because there's a lot of hysteria around at the moment.
Indeed.
Everybody's saying, 6.8, it's gone up, we're in trouble, we're going to get another rate rise Tuesday afternoon. Just to dig in a little bit, what you're saying is if you take the 12 months backwards from the April read, including the April read, and included in that backward averaging of all the months is quite large increases going back to July, August, September, October last year.
Last year, correct.
And then so when we do the May number, when we get the May number out in sometime in June this month, let's assume it's around the same as April was.
The 0.3.
We will drop off.
We'll drop down to about 6.1.
Because we'll drop the June number off.
Because you're dropping about a 0.8 out of your run rate.
So we drop last year's July number out, or whatever it is, last year's May number, April number, whatever it is.
Correct. And this is the beauty of what you can torture the data and get any result you want. I don't want to do that because inflation's still relatively high.
Yeah.
And it's only been a couple of months where it's decelerated. So we're not quite, it's encouraging to see. But what you can also do, and this is what other people do, and the Reserve Bank actually did it, not with this most recent number, but Dr. Lowe, the RBA governor, gave a speech about 3 weeks ago, and he actually looked at a 3-month moving average
Yep.
on monthly inflation. So you might think, well, that's just quarterly inflation, isn't it? The short answer is no, because you're getting the quarterly inflation numbers, just sort of the average of January, February, and March divided by October, November, December, the 2 quarters.
Yep.
Whereas if you get a 3-month moving average, you pick up turning points in December was high, then January was a bit lower, then February. So your 3-month moving average turns down quite nicely. So I think when you boil it down, inflation is falling in trend terms. It's not quite as low as we'd all want it to be, and we're still some way from getting to the 2 to 3% annual inflation target that the Reserve Bank looks at.
But they're happy with that.
But the momentum is in the right direction. You look at the global economy; it's weak. Germany confirmed in a recession in data earlier this week. The US is slowing down, and you look at our own domestic economy, which I'm sure we'll touch on shortly. It's slowing down. There's downside risks occurring in our economy.
Yeah, and so did the RBA governor last week in his address to Parliament, did he sort of go down that back alley that Alan was sort of alluding to? Did he play around with that?
A little. It was I enjoyed listening to it because I think it was he had the ability to sort of articulate quite nicely amongst pretty tough questioning. The Senate people who asked him the questions were pretty harsh.
No, they're quite brutal.
Yeah, they're brutal, and but he did it very well, and he was able to articulate it. Unlike you see the RBA put out a written press release, very clinical. When he was arguing and talking about the economy, about the inflation pressures, about the growth momentum, he sort of articulated why they hiked in May and surprised me and a whole bunch of other people. Anyway, can't get them all right.
Sorry about that, mate. I got it right.
I know. I owe you a coffee. But he was sort of saying, well, why we did it. And he said it was more like, not because the economy's overheating, but it's more insurance. If they want to just get that extra rate hike in there, just to sort of reinforce their strategy of telling the population that they're deadly serious about inflation and inflation expectations. And so when he was when you sort of boil down everything that he said, he's happy that the economy is slowing down. Good news. That's what rate hikes over the last 12 months have been doing. He's encouraged by the deceleration in inflation, but we're not there yet. He's starting to get a little bit concerned about house prices rebounding. We saw from the CoreLogic numbers earlier this week, a pretty chunky
1.5%.
increase. Yeah, and Sydney even higher for the month-on-month figure. So we're that fear of missing out. I'm not quite sure what the story is, but we've got house prices rebounding. He doesn't want that to happen.
Well, can we just talk about that? Because, you understand this stuff, right?
Yeah.
Does he take into account the fact that all right, house prices have rebounded a bit, but the fact that there's nothing to buy? So,
Yeah.
there's half the stock available for sale on any 1 month at the moment.
And
so prices must go up, and you're bringing in a whole lot of people into the country.
spot on, that population growth. We saw that announced in the budget on the 9th of May. So what's that, 4 weeks ago, roughly? A big increase in immigration. Now, part of that's a catch up from COVID when no one came. We know that the labour market is short of skilled workers. So, yep, fine. I think that's an important part. And Australia's a good immigration country. However, be careful what you wish for in a sense, because like good red wine, you can have too much. Immigration's good in moderation, but what we're seeing happening right now, and as we touched on earlier, building approvals are in free fall. Not many people are building a property right now. Apartments, townhouses, even individual houses. Pretty weak numbers. And population's booming. So even though interest rates have gone up, 375 basis points since May last year, and that dampens how much you and I can borrow and all this other part of the housing affordability question, the number of people coming in when there's almost no, I won't say no supply, when supply is squeezed, it puts prices up. Supply and demand. Think of your economics 101, everybody. If you've got demand booming through population growth, you've got supply not responding because people aren't building many houses. What happens to prices? They go up. And that's compounded, Mark, by the fact that, again, another Another good thing for the economy, foreign students are studying in Australia again. Great. But they're renting apartments near where all the university campuses are. So if you're looking for a one bedder or a two bedder little apartment near all the campuses around the good universities in Australia, there's nothing there. And that feeds into higher prices too.
And it feeds into higher rents as well.
Higher rents, correct, yes.
And then the higher rents encourage investors to pay a higher price because they can afford to borrow the extra money.
And hence we've got this little turning point higher in house prices.
And those two have a fair bit of weight in terms of the basket of goods and services, in terms of the inflation CPI calculation by the ABS every now monthly, but basically quarterly as well. More importantly, does the RBA look at that and say, well, I should compensate for that, or I don't know, whatever, take that into account and not put rates up because that doesn't really help anything. It doesn't affect anything.
A rate hike's not going to stop foreign
It doesn't
students
stop
coming
that.
into Australia.
And it doesn't stop them paying. They'll pay the rent they have to pay.
Correct. The RBA, I think when we've had these, what do we call it, these random shocks occurring in the economy occasionally, like when we had, remember Cyclone Yasi about a decade ago? Banana prices went crazy. That added like 1% to inflation rate. Now, the RBA is not going to hike interest rates because banana prices went up because there was a cyclone in Queensland that wiped out all the crops up there and in northern New South Wales. So,
but is this one of the exceptions?
So this rental thing is, they're aware that rate hikes will not dampen demand for rents. And so while they still acknowledge the fact that there's still a pipeline of higher rents, and as you said, it's got a very high weighting in the inflation calculation, that we're going to be seeing that higher rent feed into what will be higher inflation than would otherwise be. But they will take that into account. And I guess that feeds into this discussion why the Reserve Bank, even though they hiked in May, are a lot more cautious than they were, say, 6 to 9 months ago when they were going 50 basis points. They're going every month, that really aggressive start to the hiking cycle of, 6 to 12 months ago. They're being a little bit more cautious now. They had one pause back in April. They went again in May. So they're now, like mere mortals, will we really achieve much more if we continue to hike, or will we run the risk of running into a hard landing, or dare I say it, a recession?
Which is what's worrying me, because I think that the cohort of people who are affected by higher interest rates, those business owners, small business owners in particular, and mortgage borrowers and just borrowers generally, I think that another rate hike will be will completely dampen their enthusiasm in relation to doing business, and cost them too much money in relation to maintaining their current position. And I think that could lead over time, because he's not going to, if he puts the rates up, he's not going to go back the next month and say, oh, I better put them down. He's going to hold them for a while.
Indeed.
So it's the time he holds them for. So I think that we could actually land, but have a very hard landing.
I have to agree with that. There is like in many things in economic policy is the straw that breaks the camel's back. Again, a year ago, the first few rate hikes, fine, no problem. They were ridiculously low. So the first, 150, even 200 basis points, people didn't like it, but they managed. Then we got to 300 basis points. Oh, gee, you're hearing, the mortgage cliff was an issue. Now we're getting to this point, and I think your point, we know that the household sector, consumers, you and me and everybody listening here are an important part of the economy, but it's the small business sector that's really having a lot of competitive pressure coming from the big retailers and the like, the big business sector, which is doing fine. They're coping quite well with the
they're
economy.
doing records.
And yes, you see the NAB business confidence numbers. Business confidence from the big end of town, if I can use that phrase, is pretty good. Small businesses, they've got their mortgage on their house, they've got their bloody overdraft rate. Oh, business is cooling down. I'm trying to sell X, Y, and Z, but people aren't coming into my shop as much as they were. They're hunkering down, like we all are. And that's the slowing economy. And again, there comes a point where if you go one hike too late, too many in the cycle, you have that risk of the hard landing. And I'm old enough to remember, and with all due respect, you probably are too.
Totally.
In the late 80s,
Yep.
people were screaming, the economy's weakening, the economy's weakening. And the RBA at the time said, oh, no, it's not. We're going to keep hiking. We're going to keep hiking because some of the numbers that were coming out on inflation, on a whole bunch of data, targeted different things. It's a different situation. But RBA ignored or downplayed the anecdotes. They kept hiking. We had that horrible recession in 91, 92, 93. That was horrible. That was a really bad one, 11% unemployment. That's what happens when you tighten interest rates too much, too late, and you ignore the warning signs that are flashing right now.
So, and of course, that was the Keating-McFarlane period.
Correct.
Treasurer and RBA Governor. And McFarlane went on to say many years later, post his retirement, that the only way they were ever going to control inflation at the time was put us into recession. And
the recession we had to have.
That was Keating,
which is politically bad, but it was.
Yeah, but it was correct.
True.
It was actually correct.
Correct. Yeah.
And I don't care what anyone says, but treasurers do talk to RBA governors, and they do say maybe the only way we can fix this. And this is Chris Joy's thesis.
Yeah. Oh yes.
Let's break it. We've got to break something.
We've got to get that inflation rate back to 2 to 3 on a sustained basis, not just for one quarter. We want it there and locked in for the next 5 years.
As happened in 96, 7, 8, 9, right through to 2020.
We had a great 25 odd years of inflation, 2 to 3, occasionally spiked up and down a bit, but that's when they hiked and cut, fine. Yeah. I think Chris has actually got a very good point on that, when inflation becomes a little bit more embedded, and maybe what we've seen on those monthly numbers doesn't persist. Maybe we'll get a bounce back next couple of months. That's the joys of forecasting economics. If that is the case, and then the RBA does hike, then again, it'll be a different version of the recession we had to have. And that'll be painful for small business, painful for the household sector. And the worrying thing about that, the thing that makes me a bit concerned, is because it means unemployment goes up. That even with the latest RBA forecast, they're forecasting unemployment at 4.5 from what was the low of 3.5. That's 120,000 people who are going to lose their job on those forecasts. Now, if we get to 5 or 5.5% unemployment,
it's double.
That's another 120,000 people on top of that.
But they are forecasting 4.5%, and
Correct.
And the only way they're going to get 4.5% if employers start feeling the pinch, and the only way they're going to get employers to start to feel the pinch is by putting rates up or maintaining rates at a high level
and squeezing them Yeah, squeezing the daylights out of them. Yep, correct. And so I'm not going to hire anymore. And in fact, sorry mate, you're going to have to let you go, or no overtime, or so the labour market weakens. And that's what the RBA, again, the governor earlier this week when he was appearing before the Senate in Parliament, was saying, words to that effect. I don't want to say he said those words, but paraphrasing him, we need the labour market to weaken.
In other words, he's saying we need unemployment to kick up.
Yep.
Let's look at the board.
Oh, yes. Gee, there's been a few changes since last month. This has been good fun.
Okay, Cooey, take us through it. Tightening, neutral, easing. Where are the biases?
On our monetary policy checklist with all of the issues that filter into the RBA's deliberation, and remembering the higher up the board, the more important they are in the RBA's thinking. So GDP, the rate of economic growth, it's starting to slow down from a very high peak. I'm putting that in neutral. They don't need to hike because of strong GDP. They don't need to ease because of weak GDP.
So GDP's, they like to see around about 3+.
Give or take, yeah.
Where are we sitting?
We're currently sitting at 2.7. And after we were strong, a little period of below 3 is not bad. So at the moment, they're sort of saying, yep, they were playing a bit of catch up. That's fine. So I put that one in the neutral category.
But just to put in context, but if it was below 0, in other words, minus two quarters, that'll be in
that
the
is recession. And you say, yeah, come on, guys, you've got to cut rates.
Straight to the easy.
Correct. If we even get one quarter that's 0, and then the indicators for the next quarter, the retail sales and bits and bobs that go into GDP, if they're weak, then the odds of I'd be sliding that across pretty quickly.
Easy. Right.
Yep.
Inflation.
Bloody high.
Yeah.
If inflation was your only indicator, you'd keep hiking.
Yep. Well, but that's without taking into account the thesis that you put up that Alan Kohler also agrees with, that our run rate, if we were to go forward as opposed to going backwards, if we go forward based on the number for April, we would not. You would have inflation on it. You would have it somewhere else.
I'd have it moving towards neutral, but I want to see. I'll only move that to neutral when I get 2 or 3 months in a row that it's confirmed.
Right.
We've had 1 or 2. I need 1 or 2 more to say, okay, we've broken the back of inflation. It's twisted, it's bent, but I don't know if we've broken the back of it yet. And inflation's a bit sticky. I don't like the word, but it's a good description of inflation around the world. The US a little bit higher than they'd like to see too. So on the labour market, well, we've had a drop in employment in the month of April. The unemployment rate went from 3.5 to 3.7%. I'm going to put that in between neutral and tightening because the labour market's pretty strong. And linked to that is wages. Again, just as we were walking to the room, we saw the Fair Work Commission wage increase. They announced a 5.75% increase in the minimum wage.
So of the workforce, many people does that cover?
It covers about 20%, and through the various awards that are linked to the minimum wage. So you might be a little bit above, but of course, if you're one pay bracket above the minimum wage, you get a pretty chunky pay rise too. 5.75 is pretty high. And you've got to remember too, there's an extra 0.5% from the increase in the superannuation
1
charge.
July.
From 1 July, it goes from 10.5 to 11%. I like superannuation as a policy. I think it's a good economic policy. But if you're an employer, you've got to pay an extra 0.5%. So on wages, I'd actually put that in neutral to tightening. And indeed, the wage price index number, which came out a couple of weeks ago, confirmed annual increase at 3.7. So
that's a bit up.
Not bad, but going up.
Yeah.
Correct. So I'd put that dynamic there. Now, the international economy.
Just on that,
Oh, sorry, Mark, yeah.
What's interesting about that though, that's only a problem if employers or the manufacturer or the owner of the business, the proprietor, can actually reflect those increase in unit costs in their new price. So that's the most interesting thing. So the question on the other side of that is, are consumers of the product that the employer is paying the extra wages for, is that consumer prepared or able to pay more money for that product?
That's the critical element. And at the moment, we've got the consumer starting to hunker down. I'll touch on that in a minute too.
And I might just also add to that.
Yes, wages are only a problem if I can pass them on in my selling prices to recoup those high wages. If I put my selling price up and no one comes through my door, well,
you'll be putting your prices down.
I'll be putting my prices down to try to keep my market share. Correct.
Or the employees who are getting the extra money can now produce more widgets. So productivity is a big issue, which, by the way, productivity is down in this country. We are at the all-time low of productivity.
We are bad at it. I can't work it out because with technology, computers and machinery and things, our productivity should be booming. But I think it's because we've
that is productivity. Just make that clear. But there's the amount of output per person
per hour worked.
Yeah.
So in the olden days, using it. One example I love to use: using a pick and shovel to dig the tunnel under the Sydney Harbour, or using a machine. How many man hours would it take to dig the tunnel with a pick and shovel and a wheelbarrow? Goodness knows how many. You got this machine, you only employed probably 20 people and it digs the sort of tunnel. So your productivity is enhanced by technology, machinery, equipment. And, we need to have a big ramp up in CapEx, in capital expenditure, to get and infrastructure spending from the government sector, state and federal, to get our productivity back up. But it's pretty poor at the minute.
So we just want everyone to understand that whenever we talk about wages and the impact of wages on inflation, there are two factors. If wages are going up, but the business is producing twice as much, but wages only go up by 10%, then that's pretty good. The employee does not need to put their price up.
Correct.
Because they get the same price but with a bigger margin.
And in fact, if I could say it this way, if we had productivity growth of, say, 3% as opposed to next to nothing, wages could probably grow at 5.5 or 6%, and that wouldn't be inflationary because I'm producing more output from my labour.
Yep.
I'm getting paid for that. I'm happy as a worker getting that pay rise. You're happy as an employer paying that because you're getting more output and you're making good money.
We might need to put another category or subcategory in there, it could be productivity, but we'll move on. But they just need to understand that.
Indeed. So wage increases are not bad in themselves. It's how they come about and what the implication is for inflation from each business owner.
Yeah. In other words, can I get more money? I'm paying more. Can I get more?
Can I cover it and keep my doors open and people come in? Fine. But if it leads to people staying away because, the price of that's gone up, I'm not going to come in and buy that anymore, then the economy, that's where high wages, high inflation feeds into an economic hard landing.
Yep.
Okay, international economy. I reckon it's crook. As I said, Germany's already in a recession. The US is slowing down. China, they've had what they call these purchasing managers indexes, which I won't get into, but they're sort of like a business survey. Manufacturing, services-based, really weak. They had their opening post-COVID. They had jumped up, They're jumping back down. A lot of talk about they have to ease policy in China, which is important to Australia. And that's sort of feeding into a whole lot of issues that are causing an assessment of the global economy, hard landing, recession, dare I say. House prices, well, I'm going to put that into the neutral category, but as we didn't really spend a lot of time talking about the fact that house prices are now going up.
Yeah, for the month of April, I think it was 1.5%.
Yes, yeah.
Which is
for the capital cities.
Worse than Sydney and Melbourne.
Correct. And so after that, almost a year where prices, I think, nationwide fell about 9-odd%. We've now had 3 months in a row where they've gone up. And for the last 3 months, it's now close to 3%. So the RBA doesn't target house prices. They target inflation,
they shouldn't,
unemployment, and they shouldn't either.
But they have raised
However,
it.
They keep an eagle eye on it,
Yeah.
and when they're going down a bit, they don't care too much. When they're going up a little bit, they don't care too much. But if they start going up and up and up, they'll say, "Oh, gee, we've got the risk of a wealth effect coming through because all of a sudden housing's too strong," and that feeds into inflation too. So, but I'll put that in neutral. You wouldn't cut because of housing, you wouldn't hike. Retail sales, that's in the easing category. Zero growth in April. We've had 2 consecutive quarters where retail sale volumes have gone backwards. We consumers aren't silly. We're responding to cost of living. We're responding to rate hikes and our extra monthly repayments. We're spending less in the retail sector. Consumer sentiment, similar. So they'd probably capture those in the same sort of issue. Building approvals, we mentioned them. They're at a decade low. We're not building enough houses. And one of the thresholds for a lot of property developers is the cost of building versus what I can sell it for. Yeah, it's pretty simple maths. You don't have to be Einstein to work that one out. And if the cost of your materials, your timber, your steel beams, your floorboards, plus your wages, the tradie, the carpenter, the plumber, the electrician, and your interest costs are going up because you inevitably have to have an overdraft or borrow some money, you're not going to build it unless you can get it for a decent price. And with housing, still sort of a bit soggy, building approvals are in the...
And I think also, I remember doing this. I remember once you invited me to make a presentation to the Australian Economic Forum. I think it was called
I do remember that very
many
well.
years
Yes,
ago. And
yes.
And one of the things I did talk about on that day was, in particular, was one of the issues around building approvals is lenders' propensity to want to lend to builders. Right now, the general model that a builder works on is a 30% return.
Sure.
And so if they can't show a 30% return, then the lenders don't want to give them the money, or more importantly, lenders give them less money. But that means the developer builder has to put in more money, has to put in more equity. And they don't have more equity at the moment because they've all been busted over time with these increased costs. So therefore, builders aren't going to. They run models, and they're not going to go do a development unless there's a return in it for them.
Oh, indeed, yeah.
Which means no new housing. And
so, if you look at the number of building approvals, it's
down.
It's lower than it was in 2012 when the Australian economy was 20% smaller and the population was 15% smaller.
And I understand we've now got nearly 1.2 million houses underdone. Dwellings underdone. 1.2 million.
It's extraordinary.
Yeah,
it's extraordinary.
And this is a government solution, by the way, because it's quite complex. It's not just whether they can borrow money. It's not just the cost of building. It's not just the interest rate, but it's also councils' willingness to approve developments, and councils' willingness to approve developments is based on the voting population. The voting population doesn't want something built next door. It's so complicated. And
dear to my heart, that council approval. Not in my backyard. He said, no, I don't want to. That is a problem, and it's all very well to build properties, out in the fringes of the big cities, but not many people want to live there, even though the housing could be affordable. The schools are bad for your kids. The public transport's probably pretty ordinary. There's no shops nearby. People want to live nearby, and I think that means we've got to build up, not out, in terms of satisfying demand where people want to live, and getting council approval to put up a 5-10-story apartment block is not always easy.
And that's not because of anything other than who votes for them.
It's
about playing into the system.
Yep. Okay, we've got a few more things. So business investments, pretty good. We had the CapEx numbers, so that's neutral. You don't hike because business is doing well. Same with business confidence. We touched on that. Commodity prices, they've come off the boil with the weaker world economy, the weaker Chinese economy. Iron ore's down to $100 a tonne, so it's still okay level, but it's down from $140 a few months ago. I'll put that in neutral. You wouldn't cut or hike because commodity prices. Stock markets, choppy. Everyone's sort of watching the US inflation rate, the Federal Reserve. So I'll put that in neutral. And on current rates, even as the RBA Governor said, they are restrictive. I'm erring that towards maybe not easy. I'll put that in neutral. As you said, the RBA, even if they don't hike again, we're not talking rate cuts. No way, not yet. I know a few people, friends at Westpac, good old Bill Evans is talking about them in 2024, 25.
7.
Yep.
7 rate cuts.
We'll talk about that in a couple of months, I reckon. But for the here and now, the chance of rate cut between here and, September is 0. They're not going to do it.
Yeah.
So I'll put that one in neutral. So overall, you can sort of see the pattern here.
So what do you reckon?
It's on hold. The things that are most important are the ones that have got the greatest tightening bias. Things that are somewhat important are on the easing side. Things that are just sort of middle or in, that neutral zone. So given the risk assessment from the RBA, it's on hold. But if the RBA Governor and the board, who also vote on whether we should hike, cut or keep them steady, if they put a big emphasis on the wages side, on the inflation rate, I wouldn't fall off my chair if there's a rate hike. I don't think they need to. I think the May rate hike was the surprise. And if you look at consumer sentiment, it got smashed on the back of that rate hike. You look at the retail sales, smashed on the back of earlier rate hikes. They don't need to, but it doesn't mean they won't. I wouldn't do it, but I'm not on the RBA board.
I reckon he's going to wait for it to play out, and I don't think he'll do it. I think I agree with you. I think the May hike was the surprise rate hike, and probably, that was the one that just gave us all a backhander to remind us who's in charge, and that they're prepared to do more if they have to. That was I reckon that was strong enough. My gut feel, irrespective of the 6.8 inflation number, I think there's too many of your red dots to the right of the tightening column. And
they're moving in that direction too. That's the other thing. It's not just where they are now, that's important, but where were they, say, 6 months ago? You would have had GDP here. You would have had labour market definitely here. You would have had house prices definitely here. So there's been a drift from the tightening to neutral towards neutral to maybe easing. So I think that trend continues. And when we get the next, as an economist, I always want more data. But if we get that next inflation number and it does decelerate further, if we use Alan Kohler's month-on-month sort of run rate rather than the annual figure, we're probably going to be getting that annualised figure in the 3s, 3 point something, and all of a sudden that'll start moving towards neutral, particularly if the unemployment rate ticks up to when we get the next monthly numbers.
Or even if you use the RBA's methodology, which is like a VWAP, weighted average, price, weighted average inflation number over a period of, say, 3 months as opposed to quarterly, but 3 months, you still have a bias towards neutral.
I think so. Yes, there's enough there. And the other thing that if we look at, and the government didn't talk about this a whole lot earlier this week, but the global economy really does matter to Australia. We've not been the lone ranger in that inflation pickup. And if you look at this lovely chart on the ABS website, there's an international comparison of inflation rates. It's got all the countries that, are sort of similar to us, Canada, the US, UK, New Zealand. The inflation rate went up in every country and it's coming down in every country. So if that's occurring and we've got the risk of a hard landing in the world economy, we're going to be caught up in that. We're not going to be able to insulate ourselves, particularly if we're still hiking. And other countries are contemplating, they haven't yet delivered, but contemplating that have we done enough in rates in the US, in the UK, in Canada, in New Zealand as well.
Well, we will find out tomorrow. I think that I reckon what you should do, Cookie, is you send him a photo of this. Philip Lowe, a photo of this and just say, well, look, Mark and I were talking about it. Yep. We've been pretty on the money to date. We reckon you should have a sit back and have with the rest of your colleagues on the board and your senior economists in the RBA, have a cup of tea and some Lamingtons and just chill.
Just chill for this month. And the thing about 1 month pause, and this is the other thing to remember, and again, that rate hiking cycle that we've seen in this last 13, 14 months has been unusual because they went virtually every month. History shows that they often hike, then they'll pause for 3 months. Oh, the economy is stronger than we thought, so we'll go again. Just because they pause for 1 or 2 months doesn't mean that the rate hiking cycle's definitely over. Because if we do get to, let's just say, September, and they've paused between now and then, the unemployment rate comes back down, wages are very high, and the inflation rate doesn't drop, fine, hike again. But let's wait and see. You don't want to hike and cause recession.
I know. I'll just finish with one thing, Kooky or Steve. I think the discussion with you and I from Tuesday on every month will not be about whether there's going to be a rate hike or a rate reduction, but it's going to be for how long for.
How long
that is the issue. The bottom line is stop talking about, not us, but, stop thinking it's going to be a rate hike.
Yeah.
Think about how long is this going to last. Because how long it lasts is the thing that's going to determine whether or not we have a recession. If they get that part wrong.
Yes.
It's not just should I put the rates up one more time, but if I get that part wrong, I hold these rates for too long.
Because rates are hurting a large number of people
They're
now.
having the effect they're designed to have.
And that's what they're meant to hurt, and they are.
Yeah, and so that will become the issue for me. Yeah. How long would these guys hold the rate at where it currently is, or if they do one more, how long they're going to hold it? Because one thing is for sure, they're not going to turn around overnight.
Oh, no. They're not going to cut rate. Yeah, so rate cut talk is way premature. Look, it may happen. It's fun to talk about for 2024, but hey, we're only halfway through 23. Let's just get this next few months right.
Good to see you, mate.
Thanks, Mark.